Good evening, friends. Appreciate that all of you have taken time, beginning of the weekend. Thankfully, it was a sunny day, so we are expecting that the attendance will be good. And as we progress, you will also find the discussion stimulating and useful for all of you. On behalf of Phillip Capital, I welcome everyone and appreciate that you have taken time to attend an event which is centered around real estate investments. It is yet another attempt by Phillip Capital to talk about opportunities in markets. More often than not, we are seen talking about stock markets because we are from Phillip Capital. But there is always an endeavor to talk about newer opportunities, newer venues where our clients and investors could find ways to grow their wealth. Today's discussion is centered around real estate, both as it applies to India and also to the US. Many of us have actually experienced the great ride of the Indian real estate investments. And many of us must have also enjoyed the great capital appreciation that we saw in the real estate market. Last couple of years have been muted, but I think some of us must have also realized and experienced that with those high returns that we have experienced in Indian real estate, there was clearly an implicit higher risk that was associated with it. So at all points in time, I think an investor and an astute investor like most of you in this room, we must not forget that the risk and return are always a trade-off. And there are no free lunches. So if some of us experienced high returns and did not experience high risk, it is really an outlier. More often than not, the norm is that with high risks, there are high returns, and that's the only way it works. Going forward, there is an expectation that the high risk that has been associated with Indian real estate investments should be tempered, primarily because the market is becoming more formalized and the regulatory framework around real estate is improving and is expected to only become more sophisticated. With that, the risk profile of the Indian real estate investment should also become moderate, and the returns, therefore, should also look more modest and tempered. Today, we are also juxtaposing alongside Indian real estate investment, US real estate. And that, as many of us have known, is a matured market, a market that has grown tremendously over the last 60, 70 years. And during this period, it is characterized by moderate risk profile and very stable returns. The opportunity that we will all visualize and see today through the panel discussion that we have organized for you should present an opportunity to look at that US real estate investment more closely. And there are different ways to participate in the US real estate markets. Phillip Capital has partnered with US Freedom Capital, which is headquartered in Dallas and has been in the US real estate market for several years. They have a variety of products. Many of them are related to real estate investments and development that suit our investment limits as resident Indians under the RBI permitted investment limits on an annual basis. But more importantly, it is also suitable from some of the objectives that you and I have about participating in your US real estate market. Many of us look at US real estate not only as an investment opportunity of buy, hold, and then sell, but also a way in which we could perhaps create a long-term association with US. And that could come about because of the residential programs that the US government runs, the permanent residency or the green card programs that US government runs. And some of these special features of the US real estate as the underlying investment market should come about and should come through clearly in today's evening as it proceeds. I'm delighted to be a part of today's function. We are very happy to be associated at Phillip Capital with US Freedom Capital. And I will be equally happy if all of you in the room would find today's evening useful and productive. Thank you.
Thank you, Vinit. I would like to call upon stage Mr. Ramesh Nair, CEO and Country Head, JLL India. Mr. N. Sridhar, Group Director and Chief Strategy Officer, Hiranandani Group. Mr. Rushir Sinha, Head Debt and Co-Head Private Equity, Nishit Desai and Associates. Mr. Herat Salot, Partner, Billy Moria Mehta and Company. And I'm pleased to invite Mr. David Gunnarsson, CIO US Freedom Capital, and Mr. Stan as well.
Good evening, everyone. So I'm part of the audience, and we have collated a couple of questions from all and tried to put it in a very brief manner so that we can have a detailed insight from the most eminent facility we have from the real estate sector. To begin with, I would like to have some insight on the current Indian scenario and its outlook from real estate industry sector point of view.
Good evening, everybody, and thank you, Phillips Capital and US Freedom Capital, for this opportunity of sharing insights. Well, my take is, been talking about it, saying about it from a specific Indian context, as Hiren has mentioned. We have seen a plethora of legislations that have hit us in the last 6 months to a year's time, and as per promise, you have the demonetization that happened, then you had RERA, then you had GST, and then you have now the Indian Bankruptcy Code, now you got Indus AS hitting. So in a way, these are actually legislations which are paving the way for a new India. So let me take a pause there and take you back. Real estate, logically, or maybe in the past, has been more plagued with historical issues of delivery, execution, approvals, delays, and essentially given the land acquisition laws in the Indian context, but has moved in the last 10 years or so, where it got more institutionalized, and now we're sitting here and talking about real estate and investments. So having said that, the current market, well, I think post-demon, more overall economic indicators which got released just a couple of weeks back in terms of the GDP growth for the quarter on quarter, which was less, indicates that consumption has not kick-started, or capex has not really been, it's happened out in this country. So that's one, and more importantly, the real estate and infrastructure, all said and done in the Indian context, in the long term, is going to grow, because you have a lot of gaps yet to fill in the Indian context. So having said that, whether the current scenario, which could say extend for another 3 quarters or 4 quarters, could continue, and is there a dampening effect on the real estate or infrastructure at this point in time? The answer is definitely no. But will real estate continue to be an asset class which would give, I'm saying the audience being investors here, is the same kind of return as most of the private equity funds or investors expect? 2 times, 3 times capital. No, I think it's getting more comparable to the other asset classes, and with consolidation happening, more visibility happening, regulations coming in place, which is all very good for the sector. I think the returns are going to get moderated, and that's the way forward, I would think. But an 18 to 25% IRR is not a bad return, as I think, because people who expect anything beyond that in real estate should start looking at where they're investing and whether the right type of asset class or not. So to answer, yes, real estate is seeing a slowdown. There's been very few new launches. If you talk to anybody today on the street corner and talk about real estate, oh no, let's wait for further prices to fall down, or let's wait. I think more than that, it's more about a different asset class going to come up with all of plethora of all of this happening in the country. Commercial real estate is clearly not really that bad. It's picked up and it's moving on. The residential has seen a huge slowdown, but I think it's also location specific. Investor asset class in residential is now is diminishing, and especially with the last budgetary changes in the rent allowability from an income tax perspective, so people really wanting to have a second or third home and renting it out. So that kind of motivation is gone. And I think people are replacing it with other asset class. I can see a huge amount of inflows into the equities market, which is flowing in from the excess liquidity which is there in the market, and that's currently driving the markets too. So, but then that is because of lack of the sentiment in the real estate right now, which is making this happen. Otherwise, traditionally in the Indian context, people used to invest real estate, land, or gold.
Yeah.
And or they would put it in FDs. Now they're moving into financial instruments. India still is the lowest. I mean, it's moved from 5 to 7% of investments in financial instruments as compared to above 90 in the developed countries, the US, Europe, etc. So the next 10 years, I would say different industrial class like co-sharing of workspace, that kind of a model in terms of real estate, student housing, A-grade commercial real estate, then affordable homes and affordable luxury. Why I'm saying using both is because affordable is a contextual thing. So the price points and the location would determine, and the ticket size would make sense. So I think that's going to take a huge kickoff, because in a country of 1.2 billion, still you have got 50% of people who still need decent homes to live in. So that huge demand gap is still there. So obviously the sector is going to look forward to develop those. And as we talk about it, we also look forward to a lot of private spending happening on the infrastructure. Currently the government being the largest spender on infrastructure at this point in time. So these two in a very cohesive manner is going to take this sector much ahead. And this sector would be a large generator of employment too, as I spoke about the economic and the GDP growth just a few minutes back. So I think if I had to correlate all these points and say where this is heading for, both from a sector perspective and an investor perspective, I am pretty optimistic. And I know this has to happen because employment growth has yet to happen, and at least for the next 10 years, plus new asset class like driven by our Prime Minister in terms of Make in India is also pushing a lot of employment and manufacturing back into the Indian context. So that's going to create additional need for industrial platforms and industrial smart cities and infrastructure, and again, residential housing for the industrial smart cities to come along. So will this all happen overnight? Will it all change the immediate sentiment? The answer is, let it pass, give it a couple of more quarters. I think the current dispensation will be, is pretty strong enough to win one more 5-year term. So there will be a lot of stability, and with both Rajya Sabha and Lok Sabha being dominated by them, so getting a lot of reforms bill passed would be much more easier, and expecting people to move ahead on this would be a lot productive. So I think that's what I think is my view on the sector. I'm optimistic, and I think if people stop looking at 3 times 4x in 5 years and are content with moderate returns in this real estate asset class, and bet on good quality, good product, you will see some really nice growth out there.
Thanks, Sridhar. I mean, as we take from what we need and Sridhar both have to say is, both the government as well as the regulatory bodies are going down, are trying to cut the risk factor and going towards a moderate to a lower risk in the real estate sector. And due to this, we see that the pattern of investments or the financial products through which they would be investing in the real estate sector would also now change. If you were to advise investors, what do you think are the key trends, and whether the new financial products like REITs, investment trusts coming in, would they open a new way of investing patterns or entering the real estate sector?
So I'll start with residential, what's been happening. Post demonetization, it's been nearly 9 months. Launches down 50% across the country in the last 9 months compared to the previous 9 months before that. Sales down 55%. So it has had an impact. Surprisingly, on the price front, what we have seen is at least the price for primary, we haven't seen a drop more than 7-8% on the primary front. On secondary, some markets where there are huge cash elements like some markets in NCR or Calcutta, we have seen bigger price drops. Agricultural land aggregation has been hit big time. Plot sales have been hit big time. Many of you may remember a lot of financial stock market analysts when the demonetization announcement was done. In the second week of November, we're making predictions that real estate markets will correct 30%. Some of them had said real estate markets will correct 50%. Please remember that one of these financial guys, these stock market gurus who come on TV and make these predictions, that's because their total market, which they cater to, the stock markets in the country, is around $10 billion. That's the money which Indians save and put in stocks. The real estate sector, the industry which I represent, is a $180 billion industry per year. That's how much Indians invest in stock in the real estate sector. So every time you see on CNBC, ET Now, Bloomberg, any of the stock market guys saying big correction in real estate, please don't trust them. It is a very biased view which they give, because even a 1 billion coming from the stock markets into, from the real estate markets into the stock markets is a big jump for, if the Indian real estate markets were to crash 30%, we would have a recession like Japan for the next 25 years. So that's something we need to take it with a pinch of salt. Even before the stock market analysts comment about 0.5% drop in Reliance or a TCS share price, they do hundreds of different charts and analysis. But when it comes to real estate, it's very nice to sit in television studios and predict a 30% drop without knowing ABCD of real estate. Please look for experts when it comes to real estate. Look at their advice, and there is always the biased opinion when it comes to the stock market about real estate. Real estate will have its ups and downs, but real estate is not a market where you need to enter if you're looking at 1 year, 2 year, 3 year kind of time frame. You need to look at a 10, 15 year time frame when you're looking at real estate, and it always pays off. Although the last 7-8 years has not been a great story for the sector. I was looking at capital appreciation over the last, it's been nearly about 9 to 10 years since the global financial crisis. And capital appreciation has not been great for the real estate sector. What we have seen is Delhi has been the worst hit market. We have seen capital appreciation of only 1.5% every year in Delhi in the last 9 years. Mumbai has been around 5.75% capital appreciation, plus obviously you get rental yield on whatever I'm talking is resi. And Bangalore, which is quite a healthy market, has still been only around 4.5%. So not gone are those days. We were used to the 2003 to 2008 when even our maid servant who bought a house made lots of money. We all started thinking that we were all super smart investors between 2003 and 8. But those kind of, when we saw on average across the country, that 5 years, we saw real estate prices going up 225% overall, not per annum, but overall in that 5-year period. So everyone started getting in. What we saw post that was genuine demand was there. A lot of people who were used to the 16-17% interest rate regime, suddenly when interest rates dropped to 7-8%, it created a good latent demand from the end users. But post that, what we saw, we came back, 2009 election happened, middle of 2009 again market started looking up. To 2012, 13, that demand was actually not real demand. It was a lot of speculators, investors getting into the market without real income improvement or any massive drop in interest rates or any big infrastructure initiatives which happened. But after that, last 4 years, you've seen a correction. Few more trends which you've seen. Sizes in the last 4 years across the country have corrected by close to 22%. Previously, when developers used to sell, last part, when the building is ready, they used to sell around 15% towards the building completion. Today, that 15% has become 30% across the country. Like I said, launches down drastically over the last 3 years also. So we've seen launches actually come down 11%, 36%, and 22% in the last 3 years. So big drop in launches. Sales also down 5%, 6%, and 26%. But the good news is in the last 6 quarters, sales have been actually more than launches, which means the self-correction phase in the market has already started. Unsold inventory is down around 9%. Previously, many markets had unsold inventory of around 35 to 40 months. That's down to around 26, 27 months. So unsold inventory is slowly coming down. So that's it on the residential space. And commercial, the markets are doing very healthy. We've seen commercial demand over the last 4 years go up from 19 million to 25 million to 30 million to 36 million. So steady increase. On the PE side, we have seen investments. Ruchir can touch more on that. But again, 2 billion, 4 billion, 6 billion over the last 3 years on the PE side. The challenge with this PE is a lot of nearly 2/3 of this PE investments coming into the country is called PE, but it's mostly structured debt deals which are happening. And 90% of pure private equity which is coming is going into the commercial office space. The people like Blackstone and Brookfield and GIC buying those large office assets. Retail, again, an industry which is showing good amount of comeback. The good malls in the country, if you take at the grade A malls all over the country, we have around 750 malls totally. In that, grade A would be around 80 to 90 malls. Those malls have a vacancy of less than 5%. The bad malls, which has been status sold, where people haven't worried about what should be the adjacencies and various occupancies of the malls and not looked at catchment. Bad malls have a vacancy of 50%. Good malls have a vacancy of less than 5%. Bad malls have a vacancy of 50%. Again, coming back on the office front, we have seen huge amount of vacancy drops. Bombay market has seen a vacancy drop from 22%. All whatever I'm saying is 4 years data, 4 years back and today. Office vacancy in Bombay has dropped from 22 to 14. Delhi has gone up actually, a lot of supply happening in Delhi. Bangalore has dropped from 18% to 4%. Hyderabad from 18 to 6%. Pune from 18 to 6% again. Chennai 32% to 11%. So all office markets, what we're seeing is huge drop in vacancies. So another big asset class which is coming up in a big way is industrial. 5 large players have entered the country in industrial, new players like ESR, Warburg Pincus. You saw Brookfield now wanting to enter into the industrial space. Biggest player is Indospace, which was recently sold to Canadian Pension Plan. So a lot of activity on the industrial front. Transparency is driving a lot of international interest into India. India's transparency used to be 52 4 years back globally in the transparency index in the countries. We have a 52nd rank. Today we have come down to 36th rank. So all initiatives by Modi, whether it is your RERA, whether it's demonetization, all this is having a positive impact on making it a lot more transparent market. So that's it in a nutshell. Residential a little shaky, commercial strong, retail making a big comeback, new kid on the block industrial.
Thanks. While Ramesh maintains that, the returns are going to continue after moderate return, after the correct risk curtailing measures which the government has taken, they mature over a period of time. So in a nutshell, you mean that now the real estate industry is getting more organized and the unorganized players are moving out. And once
See, consolidation is definitely happening, but what buyers should remember is government is saying I'll create lots of supply, but they're doing exactly the opposite by curtailing supply.
right.
So prices is not dropping because of that. Look at the two markets where massive supply came in. One is Hyderabad and the other is Ahmedabad. Both these markets prices haven't gone up. Buyers are not complaining. At $5,000 you can get good homes. Look at Bombay. Today we have construction ban. Today we have the DP 2034 confusion. We have RERA, we have GST confusion. All these factors have come in, and because of which supply is just not coming. And I mentioned that launches are down 55%. So because of which at the end of the day, home buyers who want to buy cannot buy because there's not enough homes available. So government needs to come back with people like Mr. Hiranandani, where the group which Sridhar represents, are trying to create that supply, but the government is still making that supply not come into the market. Yes. And unless those massive, so if Modi is told 22 million homes is the urban thing by 2022. So we need to create 22 million homes, which means in the next 6 years, we need to create 4 million homes a year. Yeah. The best year we've been able to create only 4 lakh homes. So how will we create 4 million homes when we're just creating? You need huge amount of public-private partnerships, huge amount of government support, which we are not seeing real action on the ground on creating those homes. So that day I was speaking at one of the CREDA events, and I asked the audience, which is 300 developers, how many developers are building homes below 15 lakhs, which is the true definition of a affordable homes. Not one person put up their hand, less than 15. So where is the supply going to come for affordable housing, which the government is talking about? It's nice to make those statements, but on the ground, nobody is building.
So now, basically, there's a lot of confusion due to GST, RERA, demonetization. Maybe it is affecting the supply or the demand. So how do you think industry is coping up with it? And how do you think actual benefit of these measures is going to be absorbed to the investors?
So I think, JLL, and we go a long way back, around 10, 11 years back, when foreign funds started investing in India. And, our Indian developer community promised 28%, 30% returns. And I struggle to understand, how do you really make 28%, right? And I thought, is it an investment asset? Is it a consumption asset? How do you really look at real estate in India? Then I think I found the answer in my mother, because she said, you must buy real estate. So I thought 3 things in India are essential: investing in gold, investing in real estate, and probably third is marriage. So I think we look at these 3 things in the same light, and then I figured out that real estate is not an investment asset, it's not a consumption asset, it's an emotional asset for Indians. Because nothing else can really justify a 28% IRR expectations, and it was natural. It was very natural that most of those funds who invested, and you talked about Ahmedabad, we read 100-acre townships. No idea when will the township get completed. We did 200-acre township in Andhra Pradesh, and we poured in money like crazy. $200 million, $500 million into, going into projects, and nothing was supposed to happen. I think we are in very fortunate times right now. Expectations have tempered. Now the new mantra is, some of our friends from one of the sovereign funds tells us that if a developer promises 16%, very good return. If he promises around 20%, very good return. If it goes beyond 20, means principal not coming back. So I think that's where we are. And I think there are tempered expectations. And we are living in very fortunate times, because I think everyone realizes the potential of real estate. It is not an ultra outperformer. In fact, as Ramesh said, it's a sub-performer. If it's, to an extent, it's returning only 5% a year in terms of capital appreciation, it is not that great. And that too, if you look at from a leverage perspective, you're going to leverage at 9 or 10%, but you get a capital appreciation at 5%, somewhere there's a gap. So, but I think it's a stable asset. It's an asset which you should look at from a consumption perspective, and there's a steady demand for it. And I think that's what kind of drives the investment opportunities here. I think where people really went wrong was in terms of every small developer raising money and not being able to perform. I think what RERA really does is it brings a certain degree of moderation, it brings in a certain degree of transparency, governance, where it says that, look, you commit, you be transparent in what you commit, and then you perform what you've committed. And if you don't do that, you're responsible. And I think that in itself is a very substantial support to not just the home buyers, but also the private equity investors. You'll be surprised, but a lot of the rights of the private equity investors get challenged under RERA. Because now I cannot have my standard step-in rights, even invocation of a mortgage or something like that is challenging, because under RERA I will need the approval of the authority. But you know what, we are very happy. Every foreign investor you speak to is very happy, because they said we could anyways not enforce all of this in Indian courts. At least you have a regulator who's doing it for you. So what it has done is that it has renewed the hope in Indian real estate. Money is flushing in. Once money flushes in, you will have you will have demand coming in. You will have your demand supply equilibrium, what Ramesh was talking about. And I think that in itself is a very substantial kicker for the for the Indian real estate. GST again, demonetization again to a large extent. I mean, it was very difficult. It was becoming more and more difficult for people like us. And I'll give you my personal example. I don't, the only money I get is salary money. Now, what do I do? How do I buy an apartment? Because the developer says that you must pay X amount of money in cash. I don't mind paying cash, but where do I get the leverage? Because bank won't give me the leverage. So you know what happens? The bank says, okay, I will give you a furniture and fixture loan on this, which comes at a couple of basis points higher than my normal home loan. So what's happening? My ability to purchase home slowly was becoming more and more challenged, and there was artificial inflation. Whenever you have artificial inflation, it's not sustainable. I think what is happening right now is that you are moving into a more sustainable regime with extreme amount of transparency now coming in. Even a lot of money, and as Ramesh correctly said, is coming in as kind of structured debt. And there is a lot of comfort there, because no longer can people say, as private equity investors and private, and foreign lenders, we used to think that, you've given the money, now it's really good faith. That was the general sentiment, that when you invest in a tech company, it is debt. But when you invest in real estate, it is good faith. It is good faith investment if he feels like he'll give back, otherwise he'll not. Now with all these insolvency claims and all, I think it's a huge change. I mean, you will be surprised, in 15 days you go, and if you're a creditor, and every small creditor also can go, the petition needs to be admitted, and if it is admitted within 6 months, right? And if it is not admitted, the judge must give you adequate reasons why it is not being admitted. I mean, if you owe money, it should be admitted. And within 6 months, either the company loses control, right? The board of directors are no longer in power. The resolution professional is appointed. In 6 months, either you get your money back along with all the other creditors, or the company goes into liquidation at the end of 6 months. And no developer or no promoter wants the company to be liquidated. So as a creditor, as an investor, as a home buyer, I think this is probably the best time, to kind of be in. And now just on the, on REITs, I think again, I was a part of the drafting of the REIT regulations. And I think the way REITs have kind of come in is, I think it's good that we are waiting. Somewhere we're also involved in, I think the Embassy Blackstone REIT is about to come. They're willing to, give about 14%. It's a very high expectation. So I think I'll be very happy if it gets tempered down, because the first REIT has to happen. But trust me, I don't know, and I think I'll be very, I was very glad to hear from, from your colleague about 12% returns. And, in fact, it's a fact that, our firm is an apartment in Manhattan. That has probably gone much more than the real estate in India. And I think it's all about transparency. So I think if this REIT comes, and if we are able to get 10% or 9% yield, I think it should be very good. So it should be really wait rather than hurry into things.
A very good point made by Ruchi. Basically, a retail investor is holding real estate as an emotional asset. The reason being, he's not getting an access to big projects. So he has to partner in or invest with the unorganized sector, and where the retail investor per se is losing his money. Now, David, basically, there are a lot of retail investments in the real estate in the US. So do you think REIT is the right way India is adopting, paving a way for the real estate, paving an investment into the real estate by the retail investor?
REITs are the way that retail investors can invest. The man on the street the non-HNI can access it. So rather than a $100,000 investment as a minimum ticket size to get into a real estate project, now you have access to a much wider pool of individual investors. Maybe they're buying shares at $8, $10, $50 per share. And so for the small investor, they do now have access to institutional grade investments. And what we heard already about the transparency that comes with REITs, the US is a very mature market, and REITs have been around for a long time. They're highly regulated. They publish their, I'm speaking of the listed REITs, which is the majority of the market, they publish their financials and they have the same transparency as all other equities. And really, if you think about REITs as an equity class, that's where the US has moved to. Where real estate used to be an alternative investment, where real estate used to be equity investment, now you have almost direct correlation between the equity market and the listed REIT market. So you might choose to invest in real estate thinking that you're getting some diversification away from the equity market as a whole, but we have almost a one-to-one correlation now. There's so much liquidity in the system. There's so much liquidity being pushed to these REITs. They're being forced to buy at higher and higher and higher prices, which is pushing yields down. So to describe the yields that we see in the US in the listed market is the impression that I think most Indian investors that we speak with understand about American real estate, that they think that US real estate returns 4% returns or 6% returns, 7% returns. And I think that's true. That's the range of returns from a listed REIT. But the same opportunities that HNIs have here with a large minimum investment size is available in the US. And so equity investments in the US for an HNI should still garner a mid-teens return. 15, 18% is a good threshold IRR for an HNI investing in private real estate. So there's this huge gulf between the listed REITs and their low yields and the private real estate that are available, private investments that are available to HNIs. That hasn't changed. And some of the same challenges that you have with transparency now in private real estate here still exists in the US, but the regulatory framework has moved so far that investments in real estate are not really treated differently than investments in anything else. SEC, which is our version of SEBI, is a very, very powerful regulatory organization. They move very quickly. They put people in jail, fund managers in jail routinely. And fraud is just something that gets a very sharp, very quick response. SEC will come in, freeze bank accounts, and protect retail investor money. And so I think as you see more and more movement towards that regulatory environment here, I think you'll get more and more comfort level that we see.
If you were to say whether REITs have actually helped the development of the US real estate industry, what would be your say on it?
So one of the largest distinctions that we see between Indian real estate today and US real estate is that the US real estate environment has moved towards a capitalized income approach. And where an Indian investor might historically buy for appreciation, you buy low, you hold the investment and it's worth more later. In the US, there's so much money in the system now that the rent yields that come out of rent-paying tenants to a landlord are worth more than the building itself. The building is a vehicle to deliver cash flow rents. It's not the value of the building itself. And that is a fundamental difference between buying real estate because of its actual physical value, the land value, the building value, its replacement cost is what we call it, versus buying a stream of cash flows.
Ramesh, so how do you think that whether REITs can actually be a reality and how soon in India? This is because right now we are focusing more on appreciation model, whereas REITs would then focus more on capitalized income model. which would be based on cash flow. So how soon do you think these would be a reality in India?
Good timing, actually. I met up with the company which is planning to launch the first REIT in the country in the afternoon. And they're waiting for one final circular from the SEBI.
Okay.
And if that happens, then I think we're all set to see a first REIT in the next 3-4 months. So they've one in the next 2 weeks. They're waiting for a thing with
So this would
SEBI.
be one kind of its exceptions, or we'll see a follow through faster in the number of REITs?
So the first one is very important, and the first one is going to be an office REIT. It's a large South Indian developer who's planning to do it. So once they do it successfully, then you will start seeing REITs in retail and warehousing, all this.
Blending
Once
would
they
come
get that confidence. Right now it's only for income producing. I just wanted to ask Ruchir, you mentioned 12%, right? REITs, so you think that kind of returns they'll be able to get? Or?
No, so that's why I said that 12%, in fact, the expectation was around 12 plus, it was around 13.
I don't
That-
think these guys would give that kind of.
So I think that's the
It'll
challenge
be
where,
low
where
single
it,
digit actually.
I would say that given where your interest rates are, first of all, to just add to what David and what Ramesh did say, I think REITs in the US is more like investing in the financial instruments.
Yes.
Determined by a bunch of cash flows supporting the asset. Whereas in India, currently given how much of time we have taken even to deepen the bond markets, REIT continues to, will take some more time. One of the big questions asked of me when I was doing the private selling of my 4.2 million for $1 billion was why I didn't wait for a REIT, and probably I was right. I spoke to all the big guys and all the guys who are doing REIT now and probably waiting for the last 2 years. The depth in the Indian market and the time at which you invested rupee dollar. So your expectation of the cap rate today, and I agree with Ramesh because I don't think so it will be in double digits at all. It will be closer to, the expectation has to be 8-9%, maybe lower.
Even lower, because see,
even
today-
lower because
see, I
right
think
now.
the way they were trying to look at it was, and I know it's little, in fact, it's very ambitious. Some time back I wrote an
Somebody
article.
said 5% to me, and I said, why should somebody invest at 5%?
then
Somebody
yeah.
said 6.
You won't,
I'm like,
you won't attract the
think that's
retail
the-
investor at all. I mean, that's what it is.
And you know,
Because
see, that's
the
the
institutional
biggest-
guy comes in, he wants
No,
a compression in the.
I'll tell you what is happening. Starting with 5 to 6, but a story being created of 13, 14, like what Ruchir was saying. Say after capital appreciation.
That's exactly. So you know, and that's exactly the reason that some of our, because we've been, with you guys only, we've been meeting so many issuers and the, and the investor side both. The challenge is that your yield does not go beyond 8 or something, right? On a fully optimized tenancy basis. Now the challenge is that you say, okay, my yield is 8 or my yield is 7, then there is capital appreciation of 6% or 5% or whatever. You together try to make it around 12 or 13. Now that's one challenge which we faced as investors, that we believe that if it's really capital appreciation, then why should we invest in a REIT? We'll invest in some under construction asset.
So true.
And if you're really giving me the yield story, then your 8 or 7 in rupee terms when you are converting dollar with regulatory risk, political risk, tax risk, does not really make a good investment appetite for me, So that's where, we wrote so much and consistently always said that the REIT not being taking off is not because of the tax structuring, because that on day one, through debt structures and all, we could have easily achieved with only a 5% withholding. So it was not really hurting me as much as the commercial aspect of a REIT, that why should I really invest? So unfortunately, and that's the right way to look at it, you have to divorce the capital appreciation from the yield. If someone will buy, REIT for insurance companies and pension funds is really a stabilized yield product. So, and that's where I think the interest is lacking. And so when, Blackstone says that I want to do 12%, it should be around 12%, they're trying to mix both of them. The real story might be whatever you might say, 6, 7, wherever it reaches.
Other thing could be, because when you do REIT, I mean, as we were looking at, for example, the investor who bought it, the IRR of the cash flows as they go along with vacancies and growth in appreciation of rentals year on year, they must be targeting a 14 to 16% of IRR on cash flows coming out of that.
But when investment bankers sell their products, they don't tell all this. So
Because the cap rate of 7, 8 is what more likely people would, and then you're looking for a yield of 9% like Blackstone wants to do beyond, because they have been buying over time, the last 40 million square feet.
But today, anybody wants to sell an office asset, he can easily do a deal at around 7.5, 7.75.
The last
He
best
doesn't
deal
need to do a
has
REIT.
been closer to 8, yeah. He doesn't have, that's
Yeah.
you're right.
So
That's exactly
I'm just
what we
taking a
did.
little more discount from 7.9 with the
Possible.
GIC DLF deal happened, a little more.
In today's scenario, yes, with where interest rates are going, but it's the buyer's expectation of how much of compression in the yields that is going to get going forward. Now, given Indian interest rates, unless anybody has a view,
Which
I
the
don't think
bankers
so.
will anyway sell that story.
At 6%, are you going to go up to more than that, or are you going to go down further down? I mean, I don't think so. India will never see 3 and 4 like the US.
So if I may, one of the things that we've learned in the U.S. is that the yield is set by the shareholders, right?
Yes.
The income stream is constant, and the buyers, the retail buyers of shares of the REIT, are the ones who essentially affect the yield.
Correct.
So the higher they bid up the price, the lower the yield goes, and the market sets
Like the NAV,
the
the capital,
effective yield,
correct.
right?
It
Correct.
compensates each other. Yeah.
And so one of the challenges with REITs is that selling an asset to capture an appreciated value creates a problem for the REIT, because now they have to redeploy capital
Yes.
that's paying a current yield. So REITs are very reticent to sell assets.
I'll tell you what the story people are going to be selling, and will come out in the next 3 to 4 months. One is many of these leases are coming for expiry. So currently, let's say somebody is paying 40 rupees, their expiry leases would fetch 60. That's one story which will come up. So when it gets renewed, it will happen at 60. The second is obviously cap rate compression from 8% to 6% or whatever. We have to be with China, that story will get sold. Or Japan, or 3% cap rates and all that will get sold. Third is they will obviously talk about markets improving on the commercial front, which is definitely happening today. So rentals are going up, vacancy, like I mentioned earlier, is coming down. We did an analysis of how much is the REIT opportunity in India. So out of the 450 million office stock which is available in the country, around 250 million of that is REITable.
Oh, wow.
Out of the 250, even if 50% gets REITed, at an average rental of around 65 rupees, which is the country average today, at a 8% cap rate, we're talking of a $18 billion opportunity. So there's a big amount of opportunity for institutional and retail investors to get in. We'll get to see it in the next few months when it happens.
No, it will pump in a lot of liquidity into the system. So it's a real opportunity for, it will take some more time, because I think the countries that have implemented REIT like US or Singapore have.
But Sridhar, again, the challenge is the people who are going to get this liquidity are anyway the top 50 developers in the country, right? Who anyway don't need the liquidity.
Oh, so that's why I said that you're to start tempering your expectations on the return.
The other day, Rahejas was saying they've raised construction finance at 8%.
CMB.
So,
We are doing 9%, 9.5%.
So
These are the
exactly,
kind of
so
REITs.
they
So
don't
that's, I think,
there's no liquidity
that's-
concern there.
That's exactly the problem. For many, in fact, for most of the developers we meet, they're not able to differentiate between a REIT and a CMBS product or a or a LRD.
Correct.
So for them it's like loan का पैसा भी इतना मिलता है. This is also this much expectation. जिसमें क्या फर्क है? So I think people need to think a little differently. With REIT, it's a very different vehicle as a whole. It is different snob value. You are getting to the public. There is more transparency. You have ability to raise more capital on cheaper rates. So I think, from a developer perspective, unfortunately, that's the perspective that always comes across, right? So I am getting all the money at 8%. Why should I go through the problem of SEBI listing and all of it and expectation going anything wrong? So I think, and that's why I think probably once the first REIT goes in, you will see how it really functions. In fact, we have a pretty much retail audience. You ask them how many of them would want to invest in a REIT, today. Most of, many people who even understand it may not like to invest.
No, Ruchi, in terms of CMBS and REIT has a problem because India continues to suffer from lack of understanding because of liquidity and how the balance portion of the sponsor or the developer who has collected the REIT would be valued. If, as David said, the fluctuations in the NAV would bring down your rest of the unlisted space valuation much down. The only reason I didn't do REIT and I'm happy about that, is that because I knew that I would get this value, and I was not going to keep anything. If you're 100% clear, if you're going to retain some portion of it, like I was the other day talking to Neil, and I was talking about doing offloading 15%. So your 85% is at risk in terms of getting value. That's one of the fundamental reasons that and in CMBS, the only thing is that you can fund it at the end of 5 years as a bullet, and then you again do one more reassurance. So I think the market has so matured, and we're all looking for the first REIT, which would happen in the office space, and see how it goes. InBit, for that matter, has happened, and now it's not trading that well. Which one was the first one which happened with IRB? Because obviously the expectation was higher when it got listed, and now it's trading at a discount. So one has to keep in mind, and ultimately to reach the goal, as David said, that it is an instrument backed by a steady stream of cash flows. That's what will start driving the REIT as more as an instrument, rather than appreciating the capital gain, selling it in the market, and then trying to put the cash back into something. Will never make that money.
That's a great point. And so in the U.S., if you look at REIT yields of between 4 and 7%, that's attractive to a retail investor, right, because they're comparing what are their other opportunities to invest.
Right.
And you're comparing risk, right? Rate gives you risk. Risk equals rate. And so in the U.S., our equivalent of FD is paying less than 100 basis points.
Of the REIT.
And so now when you look at a REIT paying 4 to 7, that's an attractive return. I think you have a challenge here in that you have FD paying 6.5, and that's a safer, by definition, investment than real estate cash flows. And so
Tax-free bond pays around close to 6%, 5.5 to 6. So why would somebody put money into REIT and then wait?
right, and so I think by definition,
that
your
would
REIT
be the
returns
attitude of a retail investor.
have to be higher in order to be attractive to the retail investor.
I agree.
David, if I were to ask you that why are the HNI community in the US opting for investment in the real estate sector in the US, and whether the current investment opportunities are safeguarded from a bubble-like situation in 2008, which happened, what would be your pick from the same?
Well, first of all, I'm not going to take personal responsibility for the bubble, but certainly as a country, we were responsible for it. The bubble, just by way of reference, was a political decision by the Clinton administration to expand home ownership in the U.S. to people who are not creditworthy. And when they did so, and then those people weren't able to pay their mortgages, as the bankers had already correctly predicted, and then those were collateralized, the entire system collapsed. And so on behalf of Americans, I apologize for that. So what I do think is happening, though, is that the bankers have a whole new understanding of risk, and they went back to acting like bankers again instead of investment managers. And so we see leverage, which is just the bank's willingness to extend credit on development, depending on the asset class, at being somewhere between 50 and 70% of total cost. In 2006, bankers were lending 90%, 100%, 105% of total project cost. So the risk has been reinstated in the market, and the bankers are acting, in this particular case, responsibly.
Gee, if people were to diversify their portfolios and then make cross-border investments to a certain part of their portfolio, what would do you think would be the key challenges under the FEMA and the current income tax regime, which they should consider?
I think from a FEMA perspective, as an individual, you can invest up to $250,000 US per person per financial year, okay, in any asset or in any shares of a company that is investing in real estate or whatever. That is your availability. So if it's a family of 4, you know, you, your wife, your 2 kids and all, you could actually invest up to $1 million per year abroad. And the tax treatment is pretty much the same, because when you sell off the property, just like in India, you would end up making capital gains. There also, if you sell the property, you would end up making capital gains. So that remains pretty much neutral. So up to, I think, about $1 million is something you can manage within a family. If you want to invest more than $1 million, then the typical way in which it has been sometimes done is that you set up an Indian company you capitalize with, let's say, $1 million, you can take leverage, or you can, in simpler terms, you can borrow, and you can invest up to 4 times of the net worth of the company, which means the paid up capital and free reserve. So if you've put in, let's say, $1 million, you can invest $4 million abroad and you can borrow here. So that is, but then you will have to, you can't buy the property directly, and this is called the overseas direct investment route. You will have to buy an offshore company which is in turn owning real estate. So that is the way of doing it. From a tax perspective, I think if, let's say, you're, under this route, if, let's say, you're a foreign company, you've set up a foreign company, you set up an Indian company, which in turn invests the foreign company. That foreign company, when it sells real estate, until the time you're repatriating the money to India, there is no tax. So you can keep the money parked over there and without any taxes. The moment you get the money back into India, that is when the tax treatment triggers.
So it will be based on cash flows.
It will be based on cash flow.
Yeah.
Difference between a SPV and now there's some real estate investment which is having NCD. What is the difference between it? Earlier it was an SPV, special purpose vehicle. They used to invest through the other different developers, and now they are raising through NCD. What is the tax aspect and
your question?
Mine actually. So an SPV is. So SPV is really a company, right? That company owns real estate, okay? You can invest in the company either by way of equity, that was historically done, or you could invest the company by way of debt. There are only 2 ways of investing, equity or debt. Now, equity was the conventional way in which you become risk partners, right? Now people don't want to become risk partners, so they want to simply become lenders to the project. So therefore, they invest by way of NCDs. I will not go too much into technicalities of foreign investment and why NCDs are there, but understand NCDs to be a pure debt instrument. So you're not a private equity, you're not an equity partner, you're simply a lender. So developer will say that in equity, you're like, if I make money, you make money. Here, you make money, you don't make money, you must pay me.
And the lender has a step-in right?
Lender has that's all contractual. So if I don't pay you when I should, and what can you do? You can do whatever you want, whatever I contractually agree, those rights will be there.
Thank you, each one of us. Thank you for sharing your insights. And I think now David will take us through the opportunities which are available in the US.
Thank you.
Thank you.
Thank you, David.
Well, thank you for staying. This has been very interesting to me, and I've been coming to India now for 2 years. This is my 12th visit. Every time I come, I learn a little bit more about India, about investing in India. And what's been very interesting to me is see the rapid changes that India is going through, especially in its real estate market. And what I'd like to do is use the US as an example of what India may be in the future. And if we look back at things like mutual funds and ETFs and some of the other financial instruments that are available, then we might in fact believe that some of the things that you're seeing in the US in real estate may someday come to India as well. So just by way of background, I have 25 years in commercial real estate investments. I started my career very early as an architect. One of my clients pulled me out, went to the financial side. And in the course of that time, I've completed $950 million of commercial real estate investments in the United States. At the end of this year, I'll hit the magic $1 billion mark, which I'm very excited about. And I think that just gives you a little background on the way that we work. So our company is US Freedom Capital, and we created a fund, the US Freedom Capital Fund, specifically for global investors, global HNIs, to invest in US real estate. There are a whole bunch of reasons why direct investment by an HNI in their name in the US is a bad idea. And I won't go through all of them. But I will tell you that the fund was specifically created to solve many of those problems. First of all is tax. And tax in the United States can be avoided by a global investor. And the structures that we have built compensate for tax. And for NRIs, non-resident Indians who are investing, or in non-Indian entities that are investing, this is a complete end-to-end tax-free situation. If you're an ordinary resident Indian and you're bringing money back in, then there is tax, but we've done our best to reduce that. One of the other real significant benefits is the currency arbitrage that's available. And so recently there's been a brief appreciation of the rupee against the dollar, but if you look at the long-term trend, then the dollar continues to appreciate as the rupee. And so if you just think about it as buying low and selling high, if you move rupees to dollars today, and the rupee depreciates over time, and you bring your rupee back in, or your investment back into rupees, you've made a return just off the currency. The dollar gives you that. We believe that the dollar is going to remain the world's reserve currency for certainly the foreseeable future, and just another benefit. We offer investments for a financial return. We offer investments for U.S. green cards, and we offer investments that provide both. So we're offering both kinds. We have a 100% track record since we started our investment program in 2013. We have invested $240 million to date. And most importantly, unlike a REIT, our investments are per property and they're not pooled. If you invest into a REIT, you're investing into a giant pool. All of the risk and reward of those properties is mixed up and you get a blended average. On ours, there's complete transparency into the end property. In terms of regulation, we spoke a little bit about this earlier. The U.S. is a heavily regulated environment, and the transparency is something that I think India is headed for as we speak, certainly the regulations that are being passed. So we're licensed by our version of SEBI, which is the SEC for investment banking, for investment management. Our fund is located in the Cayman Islands. We're regulated by the Cayman Islands Monetary Authority. And then for our immigration product, we're licensed by U.S. immigration as well. So we spoke a little bit about this already, but the U.S. real estate market is huge. It's absolutely enormous when compared to any other commercial real estate market in the world. The major players in our market are listed REITs, pension funds, and the insurance companies. And so you see the hurricanes that are hitting the U.S., Houston, Florida, Puerto Rico. The insurance company funds that will be used to repay those come primarily from commercial real estate. It's a great place to store value. It's a great place to get a current return for the investment companies to pay their, insurance companies to pay their investors. And when the time comes to pay claims, it's a great store of value. We obviously have low interest rates and we have low inflation. So currently, inflation in the United States is running 1.7%, which is underneath the Federal Reserve Bank's target of 2%. And we have low interest rates, so we can borrow money for real estate at 4.5%. And if you were buying your own home in the U.S., interest rates on home mortgages are in the 3.5, 3.75, something like that. So low interest rate environment. What does that give you? Like we've already talked about, U.S. real estate is valued on the cash flow that it produces, not because it's better, but it's because it's more valuable. Cash flow is worth more than the actual building itself. Because you're focused on cash flow, now you're focused on yield, right? You have a current yield, and that's the focus of your analysis. And because of the low interest rates that we have, we can borrow money from the bank, use cheap bank money, which comes on very open, transparent, specific terms, and then we can gain a higher yield on equity that we're investing. Again, just to highlight the differences between the two, this is not good or bad. This is just, as Indians investing in Indian real estate, you've made logical decisions based on the environment that you're in. Americans investing in American real estate, have made logical decisions there. So if you start at the bottom, a low interest rate and a low inflation environment will push you to yields. The other thing that we have is the US tax rate motivates corporates to lease their office space. It has nothing to do with their ability to afford to purchase office space. It is that they're tax motivated to do so. And so you have an entire country of tenants paying rent. And that rent is the cash flow that a real estate investor is looking for. Here in India, there's a long-term trend of buy and hold, right? Real estate is a great place to put capital, and there's an emotional attachment, understandably, that goes with it. And typically, you're looking for appreciation. In order to gain appreciation, you have to sell your property. So the ability to buy low and sell high is as much an emotional decision as it is an investment decision. So what does that mean in terms of numbers in the United States? If you were to look at the rental yields that come out, and this is taking every commercial real estate building in the United States and comparing it. This is every asset class combined together. Hotels, office buildings, residential, large-scale residential, industrial, retail. It's taking the entire geography of the US, the good performing parts, the less good performing parts, putting them all together, and you can see over time, and I'm down here at the bottom, the net income, which is the rent version, is paying a 4 handle on returns, where appreciation is only paying 3.5. What's even more interesting is the volatility that goes along with this. As you know from the market here, with prices being up and down, rental yields are a nice stable return. They're boring. And they're boring. I would argue that boring is good. There's plenty of opportunity for volatility if you're an equity investor, up 40, down 30 in the equity markets. But if you're looking for something that provides nice stable returns, if you're a retiree, if you have a fixed income, then these make a lot of sense. So volatility goes away when you get into an income environment. So let me just give you an example of what the difference is between an appreciation or an equity version and a capitalized income version. This is a building we'll complete this month in Dallas. It's a healthcare facility. The completion value is $24 million. It's worth no more the day after we finish it as a building, as an empty building, than it is the day before we finished it. It's worth $24 million. That's what we spent to build it. But as soon as the rent starts from the tenant, the capitalized income that a listed REIT is paying us for this building is $32 million. They're not buying the building to own a building. They're buying a building because of the 25-year lease that the tenant is willing to pay rent on. And so that gap is why we are much more interested in income, net income, from a real estate than we are in its actual value. So what else does that mean in the US? Because of the low interest rates that we have, we want to borrow as much money from a bank as we can. Banks have very specific guidelines on what they will lend against. That's limited by the regulators. It's also limited by their internal credit committees. So a bank will also take a very specific position against the real estate. It will take first charge, as you described it, against the real estate itself, but nothing else. Maybe it'll take personal guarantees from the sponsor and things like that, but it leaves the cash flows, it leaves the ownership of the tenant, the accounts receivable, personal guarantees from the tenant. All of those things are still available to us as collateral when we come in as a second position. So on the left, we call this a capital stack. And the capital stack describes not only the amount of money that each party is putting into the transaction, but their position relative to each other. So if you're at the bottom of the capital stack, the green is your bank lender, then you're taking the lowest risk, and therefore the bank is getting the lowest return. It's getting a 4 handle on its rate. The higher the risk, the higher the return. And so if you were to think about it as a bucket, if you were to lose money in this project for whatever reason, put a hole in the bottom of the bucket. and the water drains down from the top. So the first people to lose money in their investment would be the red. That's the equity, and that's the sponsor or the developer, however you want to look at it. And the bank doesn't lose its money until the sponsor has lost all of their money. The other way around is think about it from an income perspective. Fill up the bucket, and as the bucket comes up, that's the order of payment. The bank gets paid first as there's money to pay the bank, and then the equity gets paid everything left over. So the bank's taking a fixed amount, a percentage interest rate, and the sponsor gets everything left over. So it gets a much higher return if things go according to plan. So what we do in the US, and this is simplified to show just 3 pieces of capital. On a large, say a Manhattan high-rise, you may have 20 different players in there. But everyone in that stack knows where they are relative to each other. And that's something that I think that's very interesting as part of your new regulations come out, is in the US, whether you are equity or debt doesn't matter in your ability to claim capital. It only matters relative to where you are relative to the other players. And so there are actually intercreditor agreements between all the lenders on who gets paid first and what their source of collateral is. Very highly organized. And if you were to build a 15-party capital stack, it has to be highly organized. Where am I relative to the sponsor? Well, I want more security, and he's going to want more return. Where am I relative to the bank? I want higher return, but the bank wants higher security. And so everybody organizes in there. It's very clearly understood, and if you ever had to pursue that in court, the courts recognize that as well. So our investment thesis is, first of all, we're in the US, so it's very easy to denominate our investments in dollars, and dollars in many parts of the world as the reserve currency is maybe not an appreciating part of the investment, but it's at least stable. If we go to Dubai and their currency is pegged to the dollar, there's no currency appreciation if you're holding dirhams. But if you come here and you have a long-term rupee depreciation, there might be some currency benefit. We're free of US income and estate taxes. So just as general guidance, if you take anything away from this, owning real estate in your own name in the United States is one of the most expensive things that you could probably ever do. The estate tax in the US is either 40 or 50% on your passing, and so you have now given your heirs a tax bill to the US tax authorities from an illiquid asset. So how do you get 50% of the value out of real estate? You have to sell it at whatever price you can get because the tax authority is not going to wait for their money. Very expensive. The second thing is income tax for non-US taxpayers. So if you are not today a US taxpayer, congratulations. But as an investor in the US, since 1980, the US passed a law to limit then Japanese investors from taking control of trophy properties in the United States. Rockefeller Center, Palm Beach Golf Course, things like that. That still applies today. So what we've done is we've structured our fund to avoid that as well. And as you heard described earlier, the way to do that is that we lend into the United States, and we get to avoid that. And our NRI returns, as we described, are tax-free end-to-end, and if you're ordinary Indian, then they're taxed as capital gains. Most importantly, there's a clear distinction in the US about the different asset classes that you can invest in. So if you're investing in retail, for example, or worse, hospitality, the most cyclical of all investments, it's directly tied to the health of the economy. Think about it. If you're a business owner and the economy starts heading south and your revenues are down, the first thing that you can cut that's discretionary in your business is business travel. And so business travel gets cut, hospitality immediately drops. It's directly tied to the state of the economy. On the other end of the spectrum, look at healthcare. You don't get to choose when you get sick. When you get sick, you go to the hospital, and as a result, in the population, there's a steady number of people who need healthcare, and as a result, it's completely unattached to the health of the stock market, health of the economy. That's what we refer to as acyclical. So we're investing in those asset classes. Short duration lock-in periods. If you're investing in real estate as an equity holder, you're in it until you sell it. And if the market is available, then you can sell it. And if you decide not to sell it because the market's down, you're essentially locked in. Because we're in debt, our debt has fixed duration, fixed term. We're investing for 1 to 3 years. And at the time you make the investment, you'll know what the end of that term is when your capital is available. And if you decide to reinvest, that's your decision. That's not the market's decision. And finally, there's compounding. Every time you roll over your investment, if you reinvest your interest, obviously that curve goes up and to the right. Historical yields by asset class. So we spoke on this a little bit earlier, and I've broken this up into 2 basic categories. Discretionary spending, which is shown in red, and those would be things like retail, hotels, hospitality, and office space. You can always choose to expand your office space. You can choose to renew your lease. That's somewhat discretionary, but hospitality is truly discretionary in the US. It's primarily business travel. And retail, obviously, is tied to the emotional, it's called the wealth effect in the US, is how wealthy people feel is how much they're willing to spend on discretionary items. Non-discretionary, where we're focused, is multifamily. We call this 4 lease apartments, and then healthcare. And if you look at the returns bear that out over time. If you take away the downs, a flat up is a lot better return. And so what does that mean for our investments? Just to give you an idea of what you should expect or what you should look for in the US. Our first strategy is called the current asset strategy. This is the most risk-averse investment that we offer. And so if you were to go find a building, and I'm going to give you a real example, a healthcare facility in Dallas, Texas, and that facility is open, it's operational, it's paying rent, it has patients, it has a history, and you want to refinance this into a government-guaranteed loan. So now we have government revenues from healthcare, 60% in the US. You have heavy collateral. We have a borrower who's willing to give us 4 to 8 times collateral for the amount of their loan. We have a stable existing business that has a track record that we can look at. That is about as safe and stable as US real estate gets in an acyclical asset class. And so with a 1 to 3 year term, in our product, that pays 8% per annum in dollars net to the investor. That's the kind of return that a private investor should be expecting in the United States. If you were to step that up and say, I want more return, invest in ground-up development. You're taking additional risk. You should get additional return. So the additional risk is ground-up construction and leasing it up and actually selling it to the tenant. Back to the building that we're completing in Dallas, I showed you the picture of earlier. We have a contract to sell that building to a listed REIT as soon as it's completed. What's the risk? Completing it. They can't buy it until it's complete. And that's the risk you're taking. That's why you're demanding a higher return. And so in that, it's a 2 to 5 year term. Again, it's really, you will know going in because you know the building, you know its schedule, you know that it's fully capitalized. And at the end of the completion, that building is sold, pre-sold under a contract to a listed REIT, and it's a 12% yield net to the investor per annum, paid all at the end. It's accrued. If you are interested in immigration, US green cards. You've probably heard of the EB-5 investor visa. And one of the unfortunate things about EB-5 coming to India is that it's coming with a Chinese model. And I can tell you that, because I've been there and I've seen it for myself, Chinese investors are not true risk analysts. They will sign documents put in front of them by a commissioned agent that they don't get to see all the documents. They never talk to the developer. They never visit the project. They never even talk to us. We've had Chinese investors wire money to us, and we didn't even know their name, and we didn't know the money was coming. That is a level of risk that I can't comprehend. And now when EB-5 comes to India, it's coming with those same promoters, offering 0.5% returns because that's the market. We are an investment manager first. And so the same investments that are available that I just described, that are open, they're transparent, they're collateralized, they have a known exit strategy. We're simply adjusting those so that they qualify for the EB-5 investor visa. And what does that mean? We're creating jobs that satisfies the visa program, and we're offering for our H&Is a real return, an Indian return. And so under our 8% green card strategy, this is the first time, you're the first audience to hear about this. This is a uniquely Indian product. Invest $1 million for 5 years, get green cards for you, your wife, any unmarried children in about 2 years, and get your money back with an 8% per annum return at the end of 5 years. That doesn't exist anywhere else in this country. The standard EB-5 visa that we have, which is still investing in the same projects, still has the same collateral, all of those things, but at the $500,000 level, is a market return for the EB-5 investor visa, which is 0.5% per annum, which is the same return that you would get if you deposited your money in a US bank account today. It seems low by Indian standards, but from the US standards, that's, you're getting a non-financial return on your investment. You're getting green cards for your whole family. And at the end of the time, at the end of your investment, at the end of 5 years, you will get your $500,000 back along with 0.5% per annum. So those are the two investment programs that we have. And again, the underlying real estate is all the same. So I want to just close with a brief description of risk in the US real estate and risk in Indian real estate. A couple of things that are different. Completion risk. When a US real estate developer who has a bank loan starts construction, all of the capital is in place. And the sponsor capital gets spent before the bank's loan. So that the capital stacks that we were looking at, the red gets spent before the green ever starts. The bank will ensure that all the money is in place to finish the project before the project ever begins construction. Number two, all of the permits are in place. So as I drive around Bombay and I see buildings that are half completed because they've run into regulatory or permit approval issues, that doesn't happen in the US. And so all of those permits are in place and they don't change. And not only do the investors demand that they're in place, the bank demands they're in place. And construction simply doesn't start without them. And the third significant risk mitigator, I should say, is title. Title in the US is not disputed. And the way that you can prove that for yourself is that every piece of property that is bought or sold comes with title insurance. And how do you know what risk you're taking? Look at the interest rate or the rate that's being charged. Title insurance is available on every piece of property in the US at 1% of cost. That's remarkable. There is no title dispute in the US. In part because we're a new country and the boundaries have been clearly identified and recorded since the beginning of time. So again, we look at risk as something to be avoided at all cost, even if we have to give up return in order to get it. And if you were to ask Warren Buffett, how do you maximize return over time? Never lose money. Never lose money. And that's our goal. So thank you for having us. I've enjoyed our time here. Does anyone have any questions? I'd be happy to answer them. You've been a great audience.
Could you please let us know more on that asset which basically goes in as a debt? What is the structure? How does it work? Because you said it's finally a loan being invested in the US. It's not an acquisition. How does the title come, or So you are at the lenders, are you in the lenders bucket or the equity holders bucket?
So on the right, just for ease of display, we would be in the blue bucket, and we are in fact a lender. It says preferred equity and mezzanine debt occur in the same place in the capital stack, but they're different. So in order to get our tax-free status in the US, we're using the portfolio interest exemption, which has been around since the 1970s, I believe. Non-US investors, whether a corporate or an individual, lending into the US, the returns that are paid are free of US income tax. And so when we built our fund in the Cayman Islands, that was critical for us. If we were to pay 30% income tax, our 8% PA return would be 5.5. It just dilutes returns, right? So in addition to that, lenders in the US have a clear advantage in priority of repayment if something goes wrong over equity investors. And it's just a standard contract law case. And so, again, we are risk averse, and as lenders, we are taking a lower risk position than if we were equity investors in the same project.
We don't stand, your fund or your investment vehicle is a preferred equity or a mezzanine debt.
Our fund
or a lender.
Yeah, thank you. Our fund vehicle from the Cayman Islands is always debt. What's confusing there, and I apologize for that, is preferred equity is in the same place in the capital stack, and if you were an equity investor, which you would have to be under the EB-5 program, you have to invest into a company in the US, your equity, then you're in the same middle position between the sponsor, the developer, who is pure equity, and the bank, who is pure debt.
You were talking about payouts, quarterly payouts. So they are basically interest payouts or dividend payouts?
So if you're investing through the Cayman Islands Fund, you are buying shares in the Cayman Islands, which is making a loan into the US. The return of the loan to the fund is interest on a loan, but it's actually dividend payments back to India or back to wherever you're investing, Singapore or wherever.
So basically Cayman will be paying us dividends.
Correct.
And US will be paying Caymans as interest.
That's correct.
Okay.
Yes. Yes, all returns that we show are net of expense. So the fund cost is about 2% per annum. That's already been taken out. These returns are net to the investor. And one other thing that I would add is that all returns to the investor are paid before the fund manager receives anything. So gross return coming from the US, first thing it pays fund expenses. That's universally standard. The next thing, 100% of the capital goes until the investors are paid, and then only then does the fund manager, which is us, make anything. So you get paid before I do.
And this Cayman Island funds, where the funds are incorporated, are they subjected to any US regulatory laws, or what regulatory laws, if at all, they are covered by?
So the Cayman Islands Fund itself is covered under the Cayman Islands Monetary Authority, and in our part of the world, most of the funds in the US are actually housed in the Cayman Islands. And it's a tier 1 country by banking standards. The investment manager, the fund manager, our company, is governed by US law. So we're licensed by our version of SEBI, which is an agency of the SEC. As individuals, we hold licenses with the SEC. And because we're transacting business in the US, we are underneath US regulatory authority for that. The fund is in the Cayman Islands, it's regulated there. The activity of the fund managers and advisors is in the US, and it's regulated there.
But they just exercise jurisdiction over you as an investment manager and not over the funds directly.
So the funds are coming in as debt, as a loan into the US. Funds in the US, the lender is covered by US law, but that's not a financial security, that's a loan. So you're covered under contract law in the US as opposed to financial securities law.
But in that EB-5 thing, you mentioned that it's a preferred equity. So will that attract any SEC provisions?
Yes. So again, thank you for the clarification. If you're investing in EB5, you have to invest in a U.S. company, and now you are covered. Your investment is a financial investment in the U.S. So anybody offering an EB5 investment to you should be properly licensed in the U.S. The investments that we have are submitted to the SEC. They review them. If they have any comments, they send them back to us. They're on file. And should there be any problems, you're a phone call or an email away from the SEC, and I can tell you they move very quickly.
So just one last point, that EB5 investment, that will be routed, I mean, it will be a direct investment or it will also be through Cayman Island funds?
The EB5 investments go directly to the U.S.
Directly.
That's an EB5 requirement. The Cayman fund is for pure financial returns. So, and that's built to avoid tax. As an EB5 investor, you're asking for a green card, you are going to be a U.S. taxpayer.
Yeah.
I can't help you. You're going to pay taxes just like me.
Yeah, but anyway, the return is 0.5%, so it is not of material.
At the
Yeah,
$500,000
filing,
level,
yeah.
you're correct. Yeah. And again, you only pay tax on your income, not
Yeah.
on your principal. So the $500,000 is not taxed in the U.S.,
Yeah.
only the 0.5% return or the 8% return.
Thanks for the clarification.
So another question regarding the tax treatment. So the interest payments that come out from the US into your fund, of course, are tax exempt. But the dividend payouts that come post that to us in India, what is the tax treatment of that? That'll be treated as per local laws, right?
That's correct. They are treated as local laws, and I am not an expert in Indian tax, so you could ask Harat.
And could those payouts also be made to some bank accounts, foreign bank accounts that somebody might have? You could pay those in dollars as well?
Absolutely. The only requirement from the Cayman Islands, and this is a universal money laundering law, and it's really our bank, the funds bank in the Cayman Islands, is whatever account you send it from, we're going to return it to.
Okay.
You know, and there would be some drastic issue that we could potentially change it with the bank's approval. But so if you know that you want funds to be returned to Singapore, for example, invest from Singapore, they're returned to Singapore. If you invest from India, they'll be coming back to India. And so funds paid to a non-Indian, an NRI, as I understand it, again, Harat's a better answer for that.
If you are repatriating funds back to India, then it will be taxable as per Indian tax laws and it will be taxable at 30%. But if you are investing or repatriating in a favorable jurisdiction like the UAE, at the time when you redeem your UAE investments in India, at that time it will be taxable. So it is much advisable from a structuring perspective that we choose a favorable jurisdiction before making a direct investment to the Cayman Islands. But David, the one more question pops up. If I want to invest in an EB5 program, can I invest through an offshore entity into an EB5? I mean, I may be the shareholder, but under the US regulations, am I eligible for making investments into the EB5 program through my company in an offshore entity?
So this is a non-financial answer.
Yeah.
This part of the answer is governed by U.S. immigration. And what U.S. immigration wants to see for EB5, because it's an investor visa, is that the investor who is seeking the green card is actually in control of the funds. So if an HNI here wants to sponsor their nephew, for example, to get a green card, what U.S. immigration wants to see is that the HNI sent the money to the nephew's bank account, and the nephew then remitted the investment to the U.S. So if you're investing out of a company, the same thing applies. Individuals get green cards, not companies. So the company makes a distribution or a payment to its whoever the applicant is, and the applicant bank account needs to be the last stop before making the investment. That has nothing to do with financial rules. That's an immigration.
When you say that the yield for various assets is about 4 to 6%, how do you manage a 10% gross yield? So are we carrying some extra risk when you say that you are giving a debt to a property which is being constructed or which has been constructed, and the normal yield is about 4 to 6%, which you showed on one of the slides. And when you say that we get a yield of about 8% odd, plus about 2% is the cost, so it's about 10% gross yield. Is there an extra risk which you are taking? I mean, how are you able to get a 10% yield?
So again, this is a market rate that has been established over time from 25,000 EB5 investors before. And the rate of return that EB5 investors have accepted on their money is a combination of green cards for your family and 0.5% per annum. It's not that there's anything lost, that's what investors have judged to be a fair return in order to make that investment.
I'm talking about the first part, the 8% strategy.
Okay, so when you say something lost, we would like to get paid too. So if you looked at the total loan that goes to the borrower in the US, let's just say that's at 12%. That's the interest rate. So 12% per annum is being paid to the fund. The fund it's audited, it has accountants, it has the expenses of running the fund. That's about 2%. And then as the fund manager is making 2% per annum and the investor is making 8%, that's how it adds up. In the capital stack on the right, the bank is getting a 4% per annum interest rate, so that's fixed. It's not participating in profits. If on the EB5 side or the fund side, it's coming in there, and let's just say it's making 12%, again, a fixed rate, and the sponsor, as equity, gets profits that are left over. That's not a per annum rate. It's whatever money is left over when there's a capital event. And so, as I described earlier, an equity investor in the United States should be targeting a 15, maybe an 18% return on their money for being the highest risk in the capital stack. They should also get the highest return. So that's how the returns flesh out. It's not that anything's lost. It's just that lower risk is lower return, and the sponsor gets everything left over. So the question was, what's our track record in terms of number of applications that have finally gotten green cards?
Successfully getting.
Successfully. So 100% track record. What I didn't describe to you is the rest of the team that we have includes 2 former directors of U.S. immigration, and the gentleman who actually created the EB5 program are on our board. So that expertise gives us 100% track record. So we have roughly 115 applications to date, of which 80 of our investors have received their green card. And we're 80 for 80. The rest are in the queue waiting for U.S. immigration to process.
Yeah, my question basically was, what was the expense ratio of the fund that is investing money in U.S.?
It's 2% per annum. When you say the bank loan goes bust.
If there is a repayment issue or the loan default, the impact of loan default will be resulting in the bank taking their debt first. So what happens to the equity?
So as I described, so the question is, what happens to the equity in the event of a default on the bank loan? So a default on the bank loan, let's give you 2 examples. In one example, the building is under construction. And so in that case, it's not possible yet, because in the bank loan, there's an interest reserve for the period of construction plus the period at which you're going to lease it up. We're after rental income, and so we know that the tenant is not going to cash flow until it gets leased up, whether it's a healthcare facility putting patients in beds or whether it's an apartment complex and it's leasing out to people. So during that period, it's hard to imagine the scenario where the bank loan could fail. Once the business is up and operational, the bank gets paid first, or the bank gets very upset. But banks don't want to own real estate. Remember, they've just come through 2008 through 2010, where they took back a bunch of real estate, and all they're trying to do is get their 65% of value. They can't get any more than what they lent as a lender. They're just trying to get made whole with their 4% interest. What they would really like to do is have somebody interested in solving that position. And so where we're the blue position here, and we lose money, and our investors lose money before the bank does, we're highly motivated to solve that problem, right? Long before the bank ever has a single dollar of loss, we're out there solving the problem. And that's the incentive, is before we lose our money, mine, yours, everybody's together, then we're solving the problem. After we've lost all our money, then the bank loses money. And so in real estate, it's hard to imagine a scenario where it ever goes to zero. There's an underlying value to the real estate that could be sold at liquidation, you know, and say you get 70 cents on the dollar, well, the bank gets paid in full. So the bank always gets paid first, and for that it accepts the lowest return.
How the payment is to be made? Like it should be in a one slot, or like there will be an installment, so based on the constructions going on. So how we should invest like the $10 million?
Are you referring to the fund, or are you referring to EB5?
Like in this plan, like.
So under the, I'll do EB5 first. So under the EB5 guidelines, the timing of payments is governed by U.S. immigration. And so they want to see you invest your $500,000 or your $1 million into the project as a condition of applying. So typically what happens is you put together your application, and the very last day before you apply, you make the investment, and then proof of that investment is attached to your application and it goes in. So it's paid lump sum up front. In terms of the fund is a not a pooled vehicle. You know exactly what you're investing in. So we, as opportunities come up, we open a specific investment for a specific amount of dollars, and when that's filled, that one closes and the next one opens, and it just recycles. And as I described, the bank has to have all of the money in place before it is willing to go close. And you can't start construction until the bank loan's in place. So that means, again, that it's up front. Now, if we go back to number one, the current asset strategy, again, the money is invested up front, but this is an existing cash flowing asset. There's a bank loan that goes in place, but it's really a refinance vehicle rather than a ground-up development vehicle.
Hi, quick question. So I think earlier there was a mention from the panel that, you know, as an individual you can only invest around 250,000 per person, right? So cumulatively that becomes $1 million, and for that you need to set up a company here as well as in the US. So all that is no longer required for this mechanism of EB5? You just make a transfer or what?
EB5 is still required. So under the LRS scheme, it's $250,000 per PAN card, which includes a Hindu family trust. So it's a matter of combining people that you know in order to get the money out. So at the $500,000 limit, husband and wife. At the $1 million limit, husband, wife, 2 kids, or husband, wife, auntie, and nephew, right? So I can tell you that the U.S. immigration is used to seeing this. China has a $50,000 per person limit. And so they're assembling 10 people, traveling to Hong Kong with cash in suitcases, depositing it in 10 deposits into a Hong Kong bank, and the U.S. immigration is comfortable with it.
And it's only, you said only unmarried children, right, you said?
Unmarried children under the age of 21 at the time they apply, and we recommend they're under the age of 20.
And the application process begins right away as you invest, or?
Basically, your application goes in a week after you make the investment.
Okay.
Right now, there's about an 18-month queue, at which time you'll get a letter back from U.S. Immigration that says, congratulations, you've been approved. All our investors are approved. And call your local consulate and make an appointment. And right now in Bombay, it's about a month. You go down, you meet with the consular official. They put a one-time entry visa into your passport. Now all 4, let's assume you have 4 family members applying, have 6 months to travel to the U.S. for the first time. Your convenience. Go over Diwali, go anytime you want. You land at JFK with your kit and your one-time entry visa. You go through immigration, just like you go through customs, and on the spot, they will put an EB5 green card in your passport, and you're a green card holder from that day on. Now, one thing that's unique about the EB5 program is you now have 2 years to prove 2 things. One is you have to prove that each member of your family establishes residency. And what does that mean? Residents own an apartment or buy a house. They have a car. They pay taxes. You have a doctor. It doesn't mean you live there full time, but you look like a resident, not like a tourist. You only go to Orlando and you only stay in a hotel, right? That's a tourist. So you do that. That's number one. Number two is we prove that you established 10 U.S. jobs. They're not real jobs. They're economically calculated. They come from construction. In the building that I showed you, those jobs have been completed before some of our investors even applied. So we're way out in front of that. That's a process that we handle behind the scenes. 2 years later, your immigration attorney will send in a second thing. Your initial application said, this is what I'm going to do in order to satisfy my obligations. 2 years later, the application goes in and says, this is what I have done. So it's proof of residency and proof of job creation. Your green card that you started the day that you landed at JFK has all the rights and responsibilities of U.S. permanent residency. So pretty much anything but vote, be an officer in the military, and be president. But if, I won't go there. So other than that, come and go as you please. If you spend 1 month every 6 months in the U.S., that's what your immigration attorney will advise you is kind of the minimum requirement. And then one more thing I would offer is that roughly half of our investors, the wife applies with no income. No income in the U.S. means no income tax. So the wife can take the children, right, as the sponsor. The husband can stay behind, manage his business for the next 5, 10, 20 years, however long you want. At the time you choose to join your wife, she can sponsor you as either a U.S. green card holder or a U.S. citizen, and the process of husband to wife getting either green card or getting a green card as you go is measured in months, not the 17 years that everybody's used to seeing about the distant relative.
So once somebody gets an EB-5 green card, what is the taxation status? All the global income is taxed in US that day onwards for that person?
That is correct. Now, U.S. income tax couldn't possibly be more complicated, right? And so we could make broad generalizations that are big and scary. And as a U.S. taxpayer, I can tell you that we have a slabbed income tax rate, as you do, right? And no one pays the slabbed rate. There are all sorts of deductions and schemes and structures to avoid paying that. We would introduce you to a very qualified tax professional, and in the time between your application and the time that you get your green card, you can put a lot of structures in place where your income may not necessarily be taxed. We don't give tax advice. We'll introduce you to very competent people to do that. But if you take advantage of that planning, you only pay tax on income to you. If that income is going somewhere else, or it's not income, it's an asset or a factory, you don't pay tax on it. And so structuring helps.
No, but so technically, if I get a EB-5 green card and I've got investments in India, they will also be taxed in the US, in theory, but for these structures.
Yeah, there's a joint tax treaty between the US, and Tarak can speak more to that.
Then what happens is, basically, as per the local laws of US, the taxation base is based on citizenship. Under the Indian local laws, the taxation is based on residential status. Okay, so then you are a dual resident. Okay, now India and US has a tax treaty, and the Article 2 clearly speaks that there is a tiebreaker rule. So depending on the 5 conditions, you become resident of either US or either India. Yeah, it will follow year on year wise. So if you're a citizen of the US, but if you can establish that you are earning your livelihood here, your business is here, your income is here, then by Article 2 of the India-US Treaty, you become a resident in India, the tax resident in India, and you don't become a tax resident of the US. And hence you will be taxed as per local laws of India. No, even being a citizen, yeah, they are at par. They are at par, but so if you are actually traveling to the US, then you will not be taxed in India and you will be taxed in the US. So it will not happen. The apprehension that you will be taxed in both the countries, it is not possible. Because as per local laws, yes. But under the treaty, it gets taxed in either of the jurisdictions. No, resident or citizen? So you become a citizen.
And I don't qualify the 182 days or whatever the number of
In the US.
in India.
In India. So you are
I'm
not.
resident of US, I'm not resident of
Yeah.
India. And I have got income in India from investments, etc. So that would be taxed in US in that case?
Definitely. But for the tax deducted in India, yeah, on the basis of non-resident rules. So, and the rates applicable to non-residents, for that, even the tax credit will be available in the US. So effective tax, total tax, remains the same whether you are in India or in the US.
One last question, and then I
Yeah.
think it's time for dinner.
Sure, thanks. What is the likelihood of this 500,000 going up imminently? What's the sense you have?
If I was a betting man, I would say it's going up. So the program was established in 1990 at $500,000. For some reason, they never pegged it to inflation. So you're buying $1990 today. This is a $350,000 investment, and we're advising people who are interested, get it while you can. No one knows exactly when it's going up, but for the first time, the USCIS, U.S. Immigration staff, has taken the authority for itself to raise the amount of the investment. That number has floated around between 800,000 and 1.3 million, and we would expect that to happen this year, this calendar year, 2017. But no one knows for sure. There's all sorts of pressure in the U.S. to raise it. It's just a question of when.
Thanks.
Thank you all. Let's enjoy dinner.